How are you today? I know that there is lots of questions and how to get started in this crazy real estate market. If you are a buyer and you are confused, and even more so if you are a first-time home buyer and have absolutely no clue, but you're hearing all this chatter and people telling you, well, you can't buy a house, it's an impossibility. I mean, I'm hearing crazy things like whole generations are talking about this is not within their realm or their reach, and more importantly, not in their understanding. So what I'd like to do today is really just do a simple, easy breakdown for a first-time buyer or somebody new to this buying environment, meaning maybe you bought a home 10, 20, 30 years ago, and now you're like, what's the process? Is it all different? So what I want to do is take that deep dive with you. So that's why you see the beautiful ocean in the background. We're gonna do more than just skim along the surface. I want to give you some meat, something that you can really sink your teeth into, hopefully build that understanding from the ground up. And you may not be able to buy a house tomorrow, but maybe you can build up and buy a house down the road as it works for you. Whether the market opportunities open up, you build your credit, you just find the right opportunity. There are lots of ways to make that American dream a reality for you, and I want to make sure you have that information. So let me go ahead and pull up my screen here. I have this handy breakout sheet, which I will put as a link in this video so that if you want to copy it, get it for your notes and do things like that, as well as have my contact information. This is something that you could certainly take advantage of and just kind of refresh yourself along the way as you go. Not saying that this is hard set and it's the only way. I'm going to give you multiple options, but some things may be taking change in our market to come. So better things yet to come on the horizon. Something that has always been talked about is our FICO score. So this is a numerical equation that banks, lenders use to say, how are you as a credit risk and what score do you fall in? And so people are always asking, well, what's a good number or what's a bad number? What does it mean if I don't have a credit score? So we're going to go into some of those things here first when we're talking about understanding your FICO score. So the first thing is that you want to know that it is a number that is randomly based on some criteria assigned to you. Yes, there are things that you can do to build your credit, to get up to that next level, and there are things that are beneficial for you to do just in general, not necessarily just because you want to build your credit score. But then there are some options for those who don't have a credit score. And when you don't have a credit score, it's a lot of times because you pay cash for everything and you don't have monthly bills because somebody else's name is on it. I liken this to when you're a youngster kid getting started, you get your first job, you're still living at home, you're still probably in high school, and well, yeah, you don't have things in your name at that point. But as you graduate and you come into the world and now you're on your own, it takes time for those things to actually start registering in your name. So once you get that first apartment or you sign up for your phone service, your cell phone service, those are all things that eventually can help to build your credit. So let's talk about those score ranges. If you are a 720 or more, it is the best. Like, you'll get all the best interest rates, you'll get all these options. And I like to tell people, when you have money, you probably don't need to borrow money, so they're willing to give it to you on better terms, which is absolutely the reverse of what we would want. If you're having difficulties, you need some assistance, you want to be able to get into a loan so that you can start building that, they're going to charge you more. It's not as many options, and that seems opposite of what we would want out of the system. So my hope is that they will change how these scores are set and how those opportunities come about. But for now, let's go back to this score as 720 or plus, excellent skills and excellent score rating. Good score is from 680 to 719. Not a very big range if you think about it, but hey, anybody would be probably happy if they were considered good, right? Fair score. These numbers have shifted because now the fair score minimum is a 620 to 679, and it used to be poor was anything below 580. So you can see this number has adjusted to where now if you're below 620, you're considered poor, which just means it's going to be harder for you to get a loan. There's going to be higher down payment requirements, potentially higher interest rates charged, and it's just going to be a little bit more of a difficulty. Again, absolutely opposite of what we think it should be. If you have a great credit score and you really don't need the loan, you get the better rate. But you need the loan and you're really working hard and you're struggling, but you just need a little help and you're going to pay more for it, if you can even get it. So currently, if you are below 620 and you don't have an option for a loan program, then what are you supposed to do? Well, you have to start building your credit and you have to start making some very good financial decisions. So let's talk about some of these things that we have here on our list on what to do and what not to do. So what you can do that helps to build your credit is paying your credit cards on time, paying your bills on time. If you have a loan, a car loan, or your rent payments, utilities don't typically go to your credit score, but again, we are seeing where changes come into play and things that didn't used to happen are happening, and what we really want to happen doesn't happen, and it's like, oh my gosh, what do I need to do? Always pay your bills on time because a late fee is going to damage you. First of all, for your credit score if it does apply, but more importantly, it makes you feel that pressure that, oh, I'm behind, now I have to do this. So alleviate that by putting things on an automatic pay with a credit card that then you have the time to pay off in the time when you have it. So if you get paid weekly, that's a little bit easier to keep up with things. But let's say you get paid weekly and your rent is due on the 1st, but you don't have enough in your income for that week's pay to pay the whole rent. Well, you've got to start allocating some funds from the check before, the check after, so that you can start doing this. One of my favorite ways that my kids were taught from their grandma was to make sure that they took some money and put it into individual envelopes. So they'd have an envelope for their rent money. They would have an envelope for their car payment. They'd have money for for their groceries. And so by subdividing these envelopes, it gave them opportunity as each paycheck to put a little bit of money in there. Not necessarily saying you want to have cash funds on hand and envelopes that could get lost or taken. But mentally, if you think about allocating a certain percentage of each of your paychecks towards each of those, we'll call them files for those payments, that will help you. You also want to make sure that if you do have a credit card that you're keeping the balance low. So let's say you have $1,000 minimum on or $1,000 limit on your credit card. Well, as soon as you go above $300 balance on that credit card, that drops your credit score because of the usage. So if you owe $500 on it, now you're at a 50% ratio, and that's a negative impact to you. So you want to try to keep that balance when you can below that threshold of a 30% of what the total max is. Now the big thing again, making those payments on time. If you make a minimum payment regularly when it's due, it's automatically set up, and then as you get extra money you pay down more. That gives that control to you where you're not burdened and, oh my gosh, $200 came out for the automatic payment that I set up because I used the card a little bit more and now I don't have money for groceries. But if you paid your minimum of $40, then you had that extra time in order to be able to say, okay, well now I've got my groceries, let me throw another $50 over to that payment. Take the control, but set up what's automatic and minimum in order to keep that score building process working for you. The other thing you want to do is check your credit report. There's always things that can happen, a mistake that can be made, human error as well as technical error, right? And a lot of times we find this with commonality of names. So if you have a very common name, John Doe, sounds like it's a common name because everybody uses it as an example. you are going to have an issue. Like, I really feel sorry for somebody out there who's named John Doe, because that is just probably a nightmare to go through your credit report. But you can dispute if there's inaccuracies on your credit report. And by law, you're actually supposed to be able to have access to one free credit report. And sometimes if you have a credit card, you have opportunities for more of those. But at least annually, once a year, you should be checking that. Now, if you're new coming into this and you're just starting to build your credit score, you're just starting to get bills in your name, just starting off on this financial road, you may not have anything. But that's smart to check it now so that you know that you don't have any issues that needed to be corrected and that you are on a good foot. It says here that you want to avoid opening new credit accounts before you apply for a mortgage. So this is thinking long term. If you are going to go out and you want to get a home loan, then the idea that you go out and you get your car loan set up, because now you need to have your car in order to get back and forth to work. But now that I've got my car loan, let me go ahead and get a credit card. And now that I got the credit card, I'm going to upgrade my phone. So I'm going to go get a cell phone service and have that credit opened. If you do multiples of these things and then turn around and apply for a home mortgage, they're going to see all this activity, but maybe not enough history as to payment, responsibility, and timeliness of those things. And so it may be a warning sign that maybe it's going to be harder, if not difficult, for you to be able to get that home loan. So once you've established these things, then you don't want to get a bunch of credit cards opening at once anyway. So again, that example goes back to where a lot of times somebody who's now in a home loan, they're buying that house, they'll go out and they want to get new appliances and they want to get some furniture. So they go to the appliance store, they open a credit card there. They go to the home furnishing stores, they get a credit card there. And all of a sudden now, while they're in the process of doing that home purchase, these new lines start opening up. And again, it could cost you the home mortgage, because they're going to be like, no, we don't want somebody who's just going to go out and have all of these debts that we don't yet have history for. So always a no-no in opening up multiples at the same time. But when you're getting started, sometimes that's an important thing to do so that you can give yourself some history. So just be smart about it. Another thing that I always tell somebody, especially when you're first time getting started out there, is how do you start with a credit card company in order to get some option there? And a lot of times the best option is to go to your bank or financial institute, if it's a credit union or your bank in town or savings and loan. They may have an option because they have a history with you. They see maybe your income from work is coming into that account. Maybe you have a savings account with them. But they will sometimes have what's considered a prepay credit card that helps to build your credit. So it's very low limit usually. I think it starts like at $300 that you put, and you pay $300 in advance. You get this credit card, and then as you go and you buy your groceries or you buy your gas, then it pays that down, and then you repay that. So you have that limit that you're working off of. As you use it, then you pay those minimums back, and that keeps that revolving credit for you of that $300. As you build that history, and it usually takes about 6 months to a year, they see that you pay on time, that you're doing the right things, that you're managing your money, then a lot of times that will come out of a prepay scenario into an actual credit card, where now you have use of money that's not yours, and then you pay it back, and then that privilege gets accepted again as you build that credit. So that's an opportunity for you to be able to begin the process. And then you can look at other credit card options. As you know, you're going to be on the mailing list. You're going to get all this information handed to you, and everybody's going to want you once you show that you can make your payments and that you are responsible. So once those offers start coming in, that's where you want to be selective and make sure you're not just taking every offer that's given to you. You don't want to open up multiples all at the same time. I know one advice that I gave to one of my sons was, if you are looking to do a particular thing, travel, then maybe you want one that's going to give you travel rewards. If you're doing something in another aspect of life, then you want to look for what's the benefit on that, cash earnings back. Those are all different types of programs that credit card companies have. But you probably know right now, credit card usage, the interest rate to repay them back is unprecedented high. I think I've heard anywhere from 24 to 30% interest rate is being charged on these credit cards, which is insane. Now, when you need it, you need it. But when you pay it back and it takes you years to do it, if you've gone to your max amount and you're only making the minimum amount, you have to financially look at, is this really working for me, or what do I need to do to take charge of this? So let's say what not to do is make sure you don't max out your credit cards or take on all that new debt, especially before you're planning to buy a home or during that process. But in general, that's good advice as well. Don't miss your payments, because it will bottom out your FICO score. It will hit you hard, and then it's so much harder to come back up. So make sure you're making monthly minimum amount payments, and then always paying more when you have that availability. Make sure that you just don't close out old accounts. So this is somebody who's had accounts out there for a while. You maybe not in that first time situation, but you have accounts where now you're trying to clean it up because you want less on your credit report. Closing accounts also can be a negative impact to your history. So they want to see length of time that you've had credit accounts open, and that, hey, if you don't have a balance on it, it's not a negative impact, right? So, but if you go in there and you close it, now all of a sudden you lost that one that's been reporting for 12 years that you don't have a balance, or that you had paid it off and now it's all good. So you want to make sure that you don't necessarily do that. This is where it takes some good financial advice as well, which obviously we want to make sure you get in contact with the right person for that. So if you have questions more specifically about that, feel free to reach out. We'll see if we can make some contacts for you. The other thing is make sure you don't apply for multiple loans at once. And again, this is just because when they do a hard inquiry on your credit, it's going to affect your score. So liken this to, you're going to go look for an automobile. And in that automobile shopping, you may go to the Honda dealer. You may go to the Kia dealer. You may go over here to Chrysler. And each of those guys and gals are going to say, hey, no, we can pull your credit, and it's a soft pull. It's a soft pull. No worries. If you are doing a car loan, and in the matter of that day or even that weekend, you may go to multiple places, they all are going to pull your credit as a soft pull, they say, but it's all for the same purpose. And so that is less of an impact than you went to Home Depot and opened a credit card, and now you went to Morris Furniture and opened a credit card, and now you went to Macy's and opened a credit card, and now all of a sudden those three completely different companies hitting your credit is a negative impact. So that's where you want to make sure you're not opening up multiple lines of credit or doing multiple loan checks on your credit score to negatively impact it. All right, so then we've got our quick tip here. A good credit takes time to build, but making smart choices early on is going to help you so that you secure better loans, lower interest rates, and more financial opportunities for your future. It is something you really want to pay attention to. Okay, so let's talk about some tips to build your credit score from scratch. We kind of touched on some of these, but we say we want to make sure you open a credit card and do it responsibly. That's a secured credit card that you can get from a lending source that you already have a relationship with, whether that's your bank or your credit union. If you don't have any credit card, or credit card history, this is a smart way to do that. You're going to use it for your smaller purchases, and you're going to pay off the balance each month. That way you keep going back to a set zero on it. In this case, if you borrowed prepaid the $300, that you take it back to the $300 limit. Pay your bills on time. Again, set up those automatic payments, because that does help to make sure you don't miss anything, because a missed payment is going to negatively impact your credit score. Keep your credit card utilization low. Again, that's going back to that maximum amount you can borrow and keeping your threshold less than the 30%. So if it's $1,000 credit limit, You don't want to go to a 500 or 750 balance because that's going to exceed that limit. Now, you may not have a choice. Let's say you have your car, you had an engine blow up, you've had something major that's happened, and you've got this credit card. Yes, you want to use it. It's $1,000 limit. And in order to get my car fixed, it's going to cost me $800. Great. Go ahead and do it. But as soon as before that billing cycle, pay $300 down, pay $500 down, pay an amount down to help limit that impact on that first billing cycle so that you can at least get it down to that closer 30% maximum, if that makes sense. Feel free to reach out and have questions, let me know. Also, we talked about that. Don't apply for too many accounts. Make sure you're building your credit with a small loan and build up from there. And the other way that you can do this, especially for those students who may be coming out of school and trying to build this up, is by being an authorized user. So maybe mom and dad are willing to have you on one of their credit accounts so that you can be an authorized user. This helps to begin some positive payment history for you, and without having the full burden of it or being able to ruin their credit, but at least having some opportunity to get your foot in the door. And again, we talked about making sure that you do a free credit report check for yourself, and that is available at that annualcreditreport.com. And then be sure that if you see something that doesn't fit, you're not sure about, that's when you want to make sure you're reaching out to the credit card bureau and you are making the comments, disputing the information, and getting it cleared up. Again, make sure you're not closing all of those accounts, and that does affect your length of history. Once you start building that history, that's an important piece to it. Even if it's at a zero balance, you're not being charged interest to have it. Now, I'll say, if you're being charged a membership fee for having a card, you have to weigh that as, is this worth it? I mean, do I pay a $39 fee so that I have the card if I need it? I think it's a smart choice, again, just so that you have the length of history that you can keep there. All right, now we want to talk about the down payment and what you need to know. Down payment is really what's required when you're buying a house. So now we're going to switch into specifics about buying a house. So a down payment is the money that you personally have to put into the process so that you are vested in the purchase of the home. And a lot of people are like, well, what about a zero down? There are some zero down options, typically with a VA or a USDA type of loan. But other than that, most everybody else is going to fall into either an FHA, which is a government-backed loan, or a conventional loan. And the minimum amount for an FHA loan is currently set at 3.5%. And a conventional loan, some conventional loans will go as low as 3%. I think it's more typical to see a 5 or 10% on that. And then you see that they could go as high as 20%. And hey, nobody's going to turn away more money. So if you want to put 50% down on your house, they're going to love you. It's going to make the process a lot easier. But in reality, most people are like, what do I need to know? So when we start talking about an example of how much money you need, if we're talking about a minimal start of a house, and we know this price has gone up, but let's just use $125,000 as an example. If you were doing 3% down, that's $3,750 that you need in your bank account prior to making that loan so that you can show that you have the ability to do the down payment. Side note, let's just say I'm going to tell you, if you are looking at the purchase of a house, you want to have 10% of the value of the house that you are looking at in your bank account, because there are going to be additional fees that are going to come out. You're going to have to pay not only the down payment, but closing costs and other fees like the inspection, the appraisal, all of those things. And so I just say a general number for you to have in your mind is I need 10% so that I can make this house purchase. So when we are talking about overall, are you able to buy a $125,000 house if you have $12,500 in the bank and you're not dipping into it all the time? That should be your starting for your house budget. And if you have that, then this is easy because 3% of that's going to go towards your down payment. or maybe 5%. If you're doing a 5% down, that's $6,250. Now, the reason why 20% down really comes into play is because a government-backed loan like the FHA or even the conventional, if you are doing a loan and taking out more than 80% value to loan value, they hit you with additional fees. So principal, interest, taxes, and insurance is typically what make up your mortgage payment. And I'm jumping ahead here, but with that 20% down, if you don't have the PMI, the private mortgage insurance, now that gives you a little bit of a buffer, and it does save you money. So the more you put down, the lower the cost of your loan, the easier it is to get the loan potentially, because that is a favorable thing for you. But it also may not be the right thing for you to do. So I tell people that it's good to have money in your account as your reserves instead of it all being tucked away here, right? So if you have the ability to do 20% down and that financially makes sense to avoid the PMI, great, no worries. But I've had people who are like, well, I'm going to put 40% down. Okay, I get it. What's the real benefit of that? And that's where we'll do a risk assessment and understand what the numbers actually are. So by giving an additional 20%, what it knocks off of their mortgage may not really be what they are trying to do, because they want to have that extra money in their account so that when they can pay extra towards the principal, it's actually benefiting them more. And so that's why this is really good information to make sure that you're talking with somebody who understands what your end goal is, but helps you to get there in the right way. So we talked about that principal, interest, property taxes, and home insurance. That PITI is typically what that is referred to. Principal, interest, taxes, and insurance make up what your mortgage payment is. And if you understand how that works, I'm giving you some examples here on that $125,000 loan that we were talking about above. And this is, what do I need to know? How much is it going to cost me? So if you're borrowing $125,000 and your interest rate is at 4%, that means your monthly principal and interest payment is going to be $596. Now, add in your property taxes. In this example, we're estimating $200, and that gives you a total monthly payment of $796. So that was property taxes and insurance added in as that $200 figure. So your total in is less than $800. And when you consider what our rent rates are, maybe that's a great option for you. But now you're saying, wait a minute, Tammy, the interest rates are higher than 4%. So here's where I gave you that example, where currently we do have higher interest rates. And so if we're saying that that $125,000 loan is now at a 7% interest, that means your monthly principal and interest payment amount is $831. So that's a jump of over $230, with your property taxes and insurance still being the same, factored at $200. That means your mortgage payment is now $1,031 versus just under the $8 that we gave in the prior example. So this is where you see, how does that interest rate affect me and my ability to buy? So if you can afford just over $1,000 for the house payment, then that could still be an option for you. And yeah, while we want the interest rate to be lower, currently that's not where our market is. So here's what we would want to do: get into it, pay the principal down with any extra money that you have, and when the interest rates take a dive or come down even a little bit to adjust, maybe it's worthwhile doing a refinance at that point. Again, another thing to talk about, but just giving you a breakdown of all the things that really come into play. Higher interest rates equal higher monthly payments and more interest that's being paid over the time. So the faster you can pay down your principal, the better. And I always tell people, take it at the market value and what you have. And then when you have an affordable monthly payment that you can deal with, you can always pay more towards that principal when you get your bonus money or you get gift money or anything like that. Higher credit score helps to secure a lower interest rate, which can save you thousands over the life of the loan. But really, who wants to pay on this for 30 years? Let's find a way to pay it off sooner, and that's where paying additional money towards your principal will help knock that time down. All right, last thing here we get into is that renting versus owning. That's building equity versus losing equity. And it's not always the right thing to do for you to go out and buy a home. You may have to start with renting. So let's make sure that those renting choices are the right ones for you and that it is going to be comfortable and a quality of life. But as soon as you start getting into where it's stressful, it's hard to meet, you fall behind, and whether you're renting or buying, then that gets to be negative dynamics, and we don't want that for anybody. So renting is basically monthly payments that you're building no ownership for your own. It's not equity building for you. It may not even be helping your credit to build. So that's why we have more of a negative thought process regarding renting. But again, there are times when renting is absolutely the right thing. Just getting started, new community, not sure about the job. Any of those reasons are all viable options why, hey, I'm going to test this out and see if this is the right thing for me. But renting may increase over time. The cost may increase. You're going to have less responsibility as far as, oh, the toilet doesn't work or this issue happened. I need a repair, and the landlord is quick to respond and take care of those things as a result of their owning the property, right? But you have limited control over the property and or neighbors or environment. You can't just go in and paint what you want. You have to get permission. Maybe they have rules against pets. Maybe they have rules against parties. All of these things that are controlled in their lease are reasons why maybe it might not work for you, or it might be more of an impact in a negative way to your quality of life. Plus, there's really no tax benefit to you as the individual when you're renting. You take that money and you drop it. You take that money and you drop it. Now, it's helping them because it's paying down their mortgage and helping their equity, but it's not helping you. Flip side of that, if you were able and wanting to own a home, each time you make your mortgage payment, you're putting money into your equity account as well. That's building your credit history, but also building your value assets. It's fixed payments typically with a locked-in interest rate, so you're not having an escalation of anything, with the exception of potentially your property taxes and insurance. Those two factors can still be raised or lowered. As well, you can go in and, hey, I want to do a renovation in my kitchen. I want to paint purple. I want to do whatever. It's your house. You get to do what you want, right? Within reason of what the municipality may have rulings on, like with the outside, you can't do this, you can't do that. And you just want to make sure you're within zoning compliance. But other than that, it's also great for some property or for some possible tax deductions. Mortgage interest rates and taxes are potentially a benefit for you. So these are things that you would want to talk with your accountant or CPA and make sure, hey, what do I get the benefit of here if I'm buying a house? How is that going to help me financially besides the obvious that we just talked about in building your own equity, right? So the equity example that we give here, renting a home for $1,000 a month, you do this for 5 years, you've just paid $60,000 with basically nothing to show for it except for you had a place to sleep, right? Owning the home and paying $1,000 a month for 5 years, you're building your equity in that appreciating asset. So that $60,000, part of that is money back to you. Should you go to sell the house, you're going to get money back, right? Because you're going to get to sell it for more, potentially, hopefully, if the market's right and your realtor's right. But then that money you get back is basically paying you back on what you paid. Homeownership can be a smart long-term investment, and it provides financial stability and the potential for future wealth. So those are the reasons why it is really talked about, encouraged, and it is a part of the American dream that we all want, is to make sure financial wealth is something that we can gain through our daily need of a place to live. So our final thoughts here, preparing for your first home purchase, you want to check and improve your credit score before you apply for that home loan. Start saving now for that down payment and your closing cost. And Ohio has a great savings account with a higher interest yield paid for those who are saving specifically for a home. So if you want to know about our Home Smart program, feel free to reach out. I'm happy to give you all the details on that. It's like an IRA savings account for buying a home, and now's a great time to start doing that. You want to also be sure you get pre-approved for your mortgage so that you know what your budget is. And that's going to be talking to a lender that you feel comfortable with for when that next step comes and you want to do the home purchase. Understand what all your costs are. This was a quick rundown, but hopefully if you have any specific questions, reach out. We'll be happy to answer. And you want to make sure that you work with a knowledgeable real estate agent like me, just because they're going to do what's best for you. They're going to help you understand the process. And where we do this all the time, and we've helped hundreds or thousands of people, we know what the process should be and where there's a red flag and hey, this isn't normal. So we can give you that experience through the process by assisting you in there. So if you have any questions, need any guidance, drop them in the comments below, and I will put a link in this as well so that you can have access to this information that I shared. And I look forward to your future financial health and well-being, and whether that's home ownership or renting, whatever is best for you, know that we're here to help you. Thanks so much. Have a great day.